Okay guys, here's a trade that's set up on the US yen pair on November the 28th of 2011, and we're going to call this one a figure noble entry trade. Could have also called it a pivots, fibs, and a noble entry, but this is a 1 hour chart. See how price has gone up really sharply. This is an impulsive move. Look for 38% retracement levels when these kind of just really hard price action happens like this. 38's are a real popular spot for these kinds of moves to react. So that's around the figure, 7,800. It looks like it's like this lot. It looks like 38's way below the figure. It's not. It's only 6 pips different. I mean, this is a very low volatility pair right now. To get a qualified swing, we only need 7 pips, but you'll want to give it at least 10. So it came down, touched it, and bounced around down here. On the 15-minute chart, right down here, here's what it looked like, and you can look at the swing from here up to, I guess this is the high rate in here. There was actually 11 pips in that swing. Okay, so Shirley actually took this trade. She got filled right down here. She put her order in at 92 plus spread because so she bought it at 95. I mean, the low here is at 90, so she put a 10 pip risk in it. That's it. The nice thing about that, you can trade a lot of lots and still keep your risk at 1%, right? So in at 95, her targets were at 78.07 and at 70, which is the 162% retracement, pardon me, extension, and 78.15, which was a 79% retracement from this high down to this low. So those were her targets. I'll just show you what that looks like. Now, at the same time that she got in here, see, this is the beauty of using other factors. By the way, I just show you that the 79% was up here at 78.16. She got out at 15 for 20 pips. Now, here's what's really good about what you've learned in this course. At the time that this was setting up the noble entry to buy, I want to show you what the stock market was doing at the same time. On the 1 hour chart, price had made this huge run down from back on November the 13th all the way down to the bottom here on November the 25th, rallied up to, guess where? 38% back to this level right in here. And look here, let me zoom this in. Have a look at the candle action. Look at it heading down, down, down. That's negative, right? And just move that down. You can see how it was going down like that. This is the time when the trade happened actually a little bit later, right around in here. So you can see the stock market's backing off. If the stock market's going down, is that negative or positive for the US dollar? It's positive because the US dollar will usually rally when the stock market drops. Okay, because it's the risk on, risk off thing. Today was a risk on day until the end of the day when the stock market sold off and the US dollar rallied a bit. And here is what that dollar rally looked like right here against the Japanese yen, and that's where the entry was, right down in here, and the profits taken up there. So that's just the beauty of using the analysis between the stock market, for example, the dollar index, and the currency pair that you're trading. And you can even look at other cross-current pairs that are crossed with the yen to see how they're reacting. I can tell you that they were all reacting positively too. They were all rallying against the yen at the same time. So that just adds fuel to the fire. So there you go. That was on the US yen pair November the 28th, and it was a figure and noble entry trade because the figure is right here, and this was the noble entry, the rally, the dip, and away she went. There you go.